So I think this will be fun. I'm going to do a beginner's view of cryptocurrency, how you first start dealing with it, and then I'm going to go all the way through NFTs and DeFi and the like, and it should be a lot of fun. I hope that Professor Liu didn't leave because I actually disagree with him on just about everything. So
you disagree with everyone. Yeah.
That's true. I'm just a problem child.
Like your
Thank you. So what I'm going to do is I'm going to just start with the simplest things. Wallets, on-ramps and off-ramps for cryptocurrency. It's not as easy as you may think if you haven't gone through it yet. Talk about exchanges a little bit, move into staking, talk a little bit of tokenomics, because this is actually very critical if you're thinking about using this as an investment or something else. I will move through non-fungible tokens. Liquidity pools are something that everyone should know about. I'm a baby boomer, and if you all are thinking on investing in cryptocurrency for your children and grandchildren, you are behind the times. It is a horrible idea. Everything has gone up tremendously. With a few exceptions, you're not going to see that very often. Cardano might be one of them. Everyone's high on it, basically because it's an Ethereum killer. It's cheaper, it has more capabilities. It's just a question of how the market runs and whether that works, because there are other contenders. Play to earn games. That's something that's very important, particularly in the third world. So wallets. Wallets are kind of a misnomer. Your cryptocurrency isn't held in your wallet. The only thing that your wallet really is a set of keys. And they're keys you can't afford to lose. I'm going to stress that a little bit. All that you really need is a keychain. And a lot of the blockchains that you may interact with, other than the standards, they actually only have you use a keychain. And then most of your operations are done with dApps and things like that. Your keychain keeps track of your private keys. Other than that, there's not much that you need. Different types of wallets. So there are online wallets and there are browser extensions. You know your wallet is online when you're having to enter a password and this password goes to some website. Needless to say, this isn't a good idea, but often it's unavoidable. Browser extensions are nice because fundamentally they keep your keys on your computer, encrypted. Now you are entering a password to use them, but that password isn't going across the net, your keys aren't going across the net. Generally it's very safe. Now, one thing you don't want to do, and I've seen people do this because I used to do it, there are things like MetaMask. It's the browser extension for Ethereum that most people use. People log in at the beginning of the day and do whatever they want. If you leave your machine, if someone else walks up, all your cryptocurrency is theirs. So whenever you use MetaMask, use it to sign or whatever, log out immediately. There's software. I've talked about the software type wallets. Those are your online wallets and something like MetaMask. A hardware key is something that you just plug into your computer. It contains your private key. It will not tell anyone your private key. And it runs basically the same way in which a software key does, but it's much more secure. Also, all hardware keys, well, at least the ones I'm aware of, the popular ones, do integrate well with MetaMask and things like that. So particularly if you have a lot of money in cryptocurrency and the like, I strongly recommend that you want to get a hardware key. People have often heard about hot wallets versus cold storage wallets. The difference is that hot wallets are used for transactions on a regular basis. Most often exchanges and large companies will divide their wallets this way. It's a safety measure. things that are in cold wallets really can't be stolen as easily as hot wallets. Too many people have access to the keys of hot wallets. Not true of cold wallets, cold storage wallets. So initially, though it's getting easier, just getting onto cryptocurrency isn't the easiest thing. If you're trying to convert fiat into cryptocurrency, you're going to have to go through one of three methods. One is, of course, the exchanges. This is the method that everyone uses. The downside is of course, there's KYC AML, know your customer, anti-money laundering. You're going to have to upload a selfie, your driver's license, your mother's maiden name, your firstborn child. They will know what you're doing. Though honestly, regardless of that, for the vast majority of non-privacy coins, everything is ultimately trackable. Bitcoin, the federal government has figured out now. They know who sent which transaction. They've tied your address to your identity. There are websites where you can do paid tasks, like a Mechanical Turk type thing. You can gain cryptocurrency this way. The same is also true for a lot of the play-to-earn games. Very often, you can get in-game assets. Most of the time, they're implemented as NFTs, and as you go along and you play the game, and particularly if you're good or if the game catches on, there can be a lot of money there without you having to put any money at all in. Off-ramps are the exchanges. You can also buy various products and services using cryptocurrency. You can also sell in-game assets very often for fiat and things like that without people recognizing it. So cryptocurrency is a lot more than just Bitcoin. I'm a Bitcoin minimalist. For me, it's one of those things, Bitcoin doesn't do anything that another cryptocurrency doesn't do faster, cheaper, better. It's going to be interesting to see what happens to Bitcoin, but I sold all my Bitcoin quite some time ago. Very healthy profit, but I don't want to guess what it's going to do in the future, just particularly when Elon Musk says something. So there are two different types of exchanges in a way. One is the regulated exchanges, all the big names that you hear, Binance, Kraken, Coinbase, things like that. These are very simple to stock traders. They actually have two purposes, if you believe in the first one. One is you can actually store your money there. Again, this is a bad idea. Exchanges take your on-chain currency, take it off-chain, and just keep track of it with their own internal records. This is why things like Mt. Gox happen. It can't happen if it's stored under your keys. When you give it to them, it's under their keys, no bets are off. You know, Bitcoin has never been hijacked. How many exchanges have you heard that had major losses with Bitcoin? You know, it wasn't Bitcoin's fault. Well, these are tough to read here. So one of the things, the other alternative that you have are so-called DEXs. What they are is they're distributed exchanges. What they're very convenient for is for converting one same-chain token to another same-chain token. So if you want to convert Ethereum to any other ERC token, it's very easy to do. Life becomes slightly more difficult when you want to convert, say, from Ethereum to something that's Binance Smart Coin, Binance Coin, where it's on the Binance Smart Chain. For that, you need bridges and the like. If you want, you can stay entirely off the radar when you're using distributed exchanges, though of course, again, if you're using the same address, they know who you are. In both cases, there are reasonable sized fees. In the case of the exchange just makes a good profit. For the liquidity pools, it is the people who loan money to the pools. Gerard mentioned that banks don't need your deposits. Liquidity pools definitely do. They have no money on their own, so they pay you a portion of their fees if you donate or loan them money. Professor Liu already mentioned coinmarketcap.com. You can't live without it. You know, it just tells you what everything is worth, where it's trading, what the news is. Can't say enough about it. So there are several different types of staking. Originally, it was staking for consensus. That's the so-called proof of stake rather than proof of work. When you're staking for consensus, based on how much you stake are your odds for getting to write the next block, and then you get block rewards. These are not as much as Bitcoin awards can be, but for Ethereum, they can be fairly hefty, or they will be fairly hefty. There are other purposes for staking, however. Those of you who work in the United States government, what you hear of as sequestration is not a proper use of the word. It simply means to separate something. Part of staking's purpose in this case is that if you lock up a bunch of the money, it makes the rest of the money, or the cryptocurrency that is acceptable, worth more. It's the law of supply and demand. You've basically decreased supply. A lot of games in particular have tokens that when you stake them, they will give you additional rewards. Either they'll give you more cryptocurrency, they might enable you to join tournaments. In terms of the GBA token, we let you attend certain additional events. And I'll just pretend that I can read those. I assume I covered them all. So there's also just staking for profit. I've removed all instances of whose offer this is, but oh, look at those interest rates. Aren't they amazing? So in particular, you ought to notice cake there. You know, 37% is pretty huge. So one of the things that you need to know the difference for when you're even starting to do any sort of DeFi is the difference between annual percentage yield and annual percentage rate. An annual percentage rate is just the yearly amount that you get. The annual percentage yield takes into account compound interest. A lot of these places for you, and if you notice the difference up there, I'm not sure that it's legible, but if you're just keeping Pancake or cake around, it's got an annual percentage rate of almost 60%, which, if you notice the last slide, the exchange is giving you 29. They're making a good profit. The downside, of course, is they're the ones exposed to the volatility. However, if you compound it once or twice a day, suddenly you're talking about 78% annual percentage rate. Staking coins can give you an awesome return. It can also kill you, because if you stake a coin whose value rapidly decreases, you're the one taking the loss. There are a whole bunch of different places that do this type of staking. I could recommend this for coins that I would trust. There are very few that I would tend to trust. You might want to read up on Pancake. There's Pancake Swap. It does a whole bunch of stuff. It's a great DEX. It converts coins. It also does this. But I don't offer financial advice. I don't want to be responsible for financial advice. So tokenomics are really just simple economics. The size of the pool of tokens matters tremendously. The larger the size, theoretically, the less volatile it is. On the other hand, we have Bitcoin. It tends to be very volatile, and it is huge. It's also interesting because it drags most of the other coins along with it, at least in the short term. So if you look at coin market caps, little graphs, you know, most of them will tend to follow closely Bitcoin's ups and downs. Demand matters. Those coins that are in demand go up in price. Those coins with too much supply go down. But this also matters in things like NFTs and for play-to-earn games. At that point, you need to analyze the tokenomics in terms of what are the sources, what is producing the tokens that are flowing into the environment, and the converse is what are the sinks. I've seen a lot of games fail because they have sources, they don't have sinks, and they basically devalue their currency to zero. So, non-fungible tokens. A fungible token is what your standard cryptocurrency is. Any token can be exchanged for any other token. It's like one coin versus another. 1/4 equals another. Non-fungible tokens are either unique or semi-unique items. A painting, for example. In a lot of the play-to-earn games, things like cards, if you're playing a card game. Things like swords and armor and the like, if you're playing a fantasy-type game. Those are semi-fungible. There's actually a new Ethereum standard for it. Some people are using it, some people aren't. Can I get my slide back? No worries. Sinks are where cryptocurrency is burned. For example, if you can buy things in-game. A lot of the card games, the best token sinks are just the ability to buy more cards. Tournament entry fees, just anything that gets some of that reward out of circulation, because that way you keep reasonable amounts, people have a reason to actually buy it, and you know, it keeps it stable and necessary. Should I try and go with that? Wing it.
Any other questions while we wait for the slides to be back?
Go ahead.
Go ahead.
Yes, Mark, briefly on NFTs. One of the key characteristics of NFTs today is that the media itself, that being a painting or music score or film, are stored off-chain. Do you agree that the true market for NFT is only possible with so-called true NFTs, where media is also stored on blockchain, unlike it is done now?
So, well, I guess the question is it a true NFT? There are very few true NFTs right now. Most of the NFTs either store the media on a company's servers, which is very, very bad, or they put it on the interplanetary file system, IPFS, which can be problematic if they don't pay, you know, the necessary fees. I'm aware of one of our partners is actually insuring the NFTs so that their prices are paid in perpetuity. I know that there are other companies using AWS with the same type of deal where they basically buy, you know, services in perpetuity. Those are arguably real blockchain-based NFTs. You know, even if it isn't on the blockchain, it's definitely safe. So, Yes, I was about to restart. So what NFTs can be used for is a wide variety of things. I've mentioned in-game assets, artwork everyone knows about. Banksy sold a NFT, original art, for a few $1 million, nothing worth that much. There are also these amazingly horrible 8-bit sort of pictures that have been selling for hundreds of thousands and now I believe over $1 million. I don't quite get that. It must be the fact that I'm old. I think so. One thing that seems to be very, very popular now are sports memories. Has anyone heard of NBA Top Shot? I mean, basically you get a little bit of video of a player's best, moments, and you get to keep them. Fundamentally, it's baseball cards. And I think that it'll probably have the longevity of baseball cards. I think that a lot of these NFTs are going to be around forever, even if they don't have utility, which the in-game stuff certainly does. There's also a little bit of use of tickets as NFTs. We're actually planning to do that for our big event. That way you can not only have something that you can present at the door, but you have a memory of one of the things that you went to. And there are a lot of so-called POA NFTs, which is a proof of attendance. So again, you can keep your memories. Liquidity pools are very interesting. Fundamentally, they exist so that a distributed exchange can convert from one type of token to another. The way in which they work is that you have a pair of tokens, and whoever loans to the liquidity pool provides an equal value of both. So say if you're providing Ethereum and Cardano, you could put in $10 of each. At that point, you get back liquidity tokens. You put those liquidity tokens in a farm, and what happens is you get regular interest, whether it's in those particular tokens or some other particular token. This sounds like a great deal. It is a great deal for some reason, for some cases. One problem is that your money is in the pool's hands. It's smart contracts. There have been a lot of problems with liquidity pool smart contracts. I would be very, very careful about which liquidity pools you go into. There are a couple that are more than large enough that I think that they've been tested enough that they're safe. For Ethereum, Uniswap is very good. Unfortunately, it's very, very expensive to get into. I mean, to the tune of a couple $100 to get your tokens in, same thing to get them out. If you want to dump a lot of money in there, it's actually good. If you want to put a little bit of money in there, choose something else. Pancake Swap is another one that is battle tested at this point. The fees are relatively small. It's on the Binance Smart Chain, which is basically a private Ethereum. Its transaction fees are basically what Ethereum's transaction fees were 2 years ago. And again, since it's a private blockchain, it's unlikely to go up that much. There are high profits. Yay! There are also what are known as rug pulls. There are a lot of cases where someone invents a token, they create a liquidity pool, and then their token goes to zero. One of the things that liquidity pools are prone to is what is called an impermanent loss, which I don't understand why it's called that, because the losses certainly are permanent. If, for example, you have Ethereum and you have Cardano, and Cardano drops in value 50%, the pool needs to equalize again so that it's got the same value of each. So what it does is it takes a quarter of your Ethereum and buys the same amount of Cardano, so it's back to 75.75. This means you've lost this Ethereum. Now you actually have a bit more Cardano, but value-wise, it's only 75% of what it was before. This can be particularly bad if the token goes to zero. This means that you lost half your investment, basically gone. So, play to earn games. This is actually a place where people can make a lot of money now. One of the interesting things that Professor Liu was talking about was risk versus reward. Now, I don't know how many people are aware of how angel investors think, but basically what they do is they throw money in a bunch of different places, say 10 different places, and they don't care if 8 or 9 of them fail. Because if they get 20x or 25x or whatever, they're making a lot of money. Play to earn games are basically at the stage now where if you invest in one, and normally you have to invest in them sight unseen a lot of the time, you can make a lot of money. I mean, 10x is not at all unreasonable, and the current failure rate is more along the lines of 50%. You have a question? Okay. So a couple ones worth mentioning is, one is Axie Infinity. It's a Pokemon-like battle game. Apparently, it's been going through the roof. It's not something that I've particularly been involved with, but they've also reached the point where there are a number of third world countries, most notably the Philippines, where there are actually a decent number of people making an exceptionally good living. They've formed some guilds. The guilds actually offer scholarships to various people who are interested. So they actually are given money to start with in-game assets, and then if they do well, they make money, and it's a virtuous cycle. And it's been very interesting watching them. Other games, as I mentioned, accept Fiat or PayPal, so this is a good on-ramp. As I said, if one takes off, 25 times or more is easily possible. If one takes off, you can make a regular income just playing tournaments if you're reasonably good. Now, the problem with a lot of these is that they've started requiring crazy amounts of investment. So Splinterlands is an interesting case in point. Splinterlands recently did a 25x increase in value after being in existence for about 3 years. Starting out, you needed about $7,000 worth of cards. To get to the highest quality competitive decks, you probably needed more like $30,000. Now, think about that times 25. That's what a lot of these things are worth now. There are also a lot of bad games. They really aren't games at all. They're just mining. I would say tend to avoid them, but if you get in early enough, there's something called Alien Worlds. They sold lots of land, initially very cheap, and then a lot of people sold out for, again, 20 to 25 times value. So a lot of what Professor Liu was saying, I tend to disagree with, because cryptocurrency in its native form, in one sense, is like trading stocks before derivatives and options came along. And there's all sorts of additional things that are possible. He talked about regulation. It's going to be a while, and they do need to regulate some of this because it's interesting. I've heard a lot of people say that the SEC isn't clear. To me, the SEC is perfectly clear. ICOs are IPOs, and if you didn't do the IPO process, you're in trouble. That's the only thing that the SEC is prosecuted on. And currently, there isn't a lot of regulation. Now, what Congress is looking at currently is incredibly dangerous. And I'm glad to be able to say this with that type of audience, because they don't understand the mechanics of how a lot of this works. There is money creation. However, the smartest money creators actually do it well within the regulations of what would be allowed for non-cryptocurrency. A lot of what they do are things like, okay, everyone, here's a little bit of free stuff. You know, it's got value, but, you know, we're giving it away for free. This passes the Howey test, no problem. The problem is that what they do is they keep a substantial amount for themselves. So suddenly, there's a whole bunch of these coins out there which suddenly have a huge value, and they're sitting on a pile of them. This is money out of nowhere. It's also something which current regulations don't handle. It's going to be interesting. It's a wild world out there. Questions?
Josh Akakian, National Artificial Intelligence Institute, Department of Veterans Affairs. So you said that the SEC has only targeted the initial coin offerings, but the SEC has also threatened lawsuits, specifically, you know, well, we'll say more recently with Coinbase and their lending of stablecoins program, saying that it was violating security law. Could you speak on that a little bit, please?
Sure. What's going on is the SEC currently is just applying standard money/security rules to cryptocurrency, which... Sorry. What the SEC is currently doing is just straight up applying standard stock rules to cryptocurrency, which doesn't seem that unfair. The problem with an ICO versus an IPO is how much money is disseminated, how trustworthy the company is. An IPO does cost money because they have their whole process you have to run through. It does take time, but it also ensures that the buyer knows what they're getting. Now, there are people who hate the SEC. They think that everyone should be, you know, a wise investor and that this is the nanny state. But really, crypto is not being treated any differently than anything else. A lot of people complain about it. Haven't seen it yet, but am very afraid of what's coming down the pike. Also, these regulations really were necessary for large companies to start getting involved in cryptocurrency. When it's the wild, wild west, the blue chips don't tend to invest. As it stabilizes, a lot more money piles in. And that's what has caused a lot of the recent run-up of Bitcoin and the like, is because you're actually now getting serious institutional investors who actually believe that it's stabilizing somewhat.
So as a follow-up to that, with potentially Bitcoin, thanks. So as a follow-up to that, with potentially Bitcoin, Ethereum, ETFs releasing, do you feel like that would harm potential investors in the crypto space to the point where, you know, these financial institutions, because according to Dr. Liu, we're at only 30-ish% of the U.S. for financial institutions being invested in the space. Do you feel like enabling ETFs would create sort of a stagnation of growth in the country since regulation has not yet been clearly identified?
So I don't think that you're going to see a lot of regulation of ETFs after the fact. Again, what they simply are proxies for a relatively volatile asset. The only way in which it would stabilize things is just by requiring a lot more, a lot more value. Again, size tends to diminish volatility. Also, as people depend upon it more, I think you'll see less speculation. As I said, however, I'm a Bitcoin minimalist. I would be surprised. Well, Bitcoin serves no real purpose right now. other than as a store of value. And one wonders how long it will remain a store of value.
Out of curiosity, based on the conversations you've had with Sandy and others, Raphael, Minnesota Blockchain Initiative, based on the conversations that are being had with the people in the halls of government, is it currently a rush to regulate out of fear? And do we think that education about the hope and the opportunity that could come to their constituents is enough to transition them the correct direction? Or is there something more that we can do as an industry, as people who operate in our own personal networks, to communicate to those around us how government's going to be touched by blockchain?
So that's an awesome question for several reasons. One is that it's actually very, very unfortunate, and I've done it myself in this presentation. Blockchain is so much more than cryptocurrency. And when blockchain as a whole starts to become threatened because of cryptocurrency, that's a tremendous problem. Cryptocurrency also has tremendous value in terms of incentivizing systems. I mentioned before that one of our passion projects is trying to do better governance, better public debate on governance. And the way in which you incentivize people is to offer them prizes. Cryptocurrency is awesome. Even reputation points tend to be worth a tremendous amount. And with that, with blockchain, you get that for free. So there's always the problem too, how many other things is a fear of cryptocurrency going to cripple? Now, we definitely need to do education. All these things, the technology is evolutionary. The reasons why the technology doesn't work most of the time has nothing to do with the technology. There have been a large number of really awesome supply chain logistics blockchain projects, and they've all gone into the side of a mountain because no one can cooperate. This person doesn't want that person getting their, business information that they can't share. There's also the problem with governments. If you're going through a country with a lot of graft, got to grease a lot of palms, really can't do that with blockchain, or at least not as easily as previously. Education is the only answer. We've got to do a much better job of all the advantages and maybe some downplaying. It doesn't help when currently liquidity pools are being hit at least once a week for millions of dollars. But, I'm not sure what you can do. There's a lot of other malfeasance on greater scale, too. But if we can educate, and we don't necessarily have to educate congressmen as much as we have to educate staffers and the like. They're the ones who collect all the information. They're the ones who summarize the information. If you can get them psyched about the potential of blockchain, and there is huge potential in blockchain, it would make for a better world.
All right, one last question.
So what I've realized over the years in this environment is that blockchain enthusiasts kind of dislike or hate Bitcoin. The biggest use case for blockchain right now is Bitcoin, right? It's the biggest market cap. It has the most amount of users right now. And I always ask myself, why is there such a tug-of-war between blockchain enthusiasts and Bitcoin?
So to correct a
Hey, Mark,
misperception.
hold on, hold on. I love both you guys. I really do. We don't have time for this.
Yeah. One
We
thing,
do not have time.
So let's just fact check something here.
All right, make your statement, and Nabil,
As
I'm
a
gonna muzzle it,
fact
okay?
check, as a fact check, Bitcoin's daily transaction rate is a minor fraction of what's going through DeFi. Ethereum by itself blows Bitcoin away. Binance Smart Chain by itself blows Bitcoin away. So far, far, far more transactions. Now, I understand market cap, but in terms of use,
I tell you what.
Bitcoin ain't there anymore.
Guys, look, and I got to tell you something. I got to say, I'm a Bitcoin maximalist myself, so I'm on Nabil's side, even though I'm shutting down. Love, Mark. We have this conversation all the time. Great stuff. Okay, Rob, how are we doing on time? All right. Oops. Oh my gosh, time's up.